All right. Good afternoon, everyone. I'm saying afternoon. Welcome to our webinar. sitting here in Johannesburg. Very nice afternoon, but I know wherever you are, you might be somewhere where it's still morning. So good morning to you. If it's evening where you are, good evening to you. Welcome to our webinar on market risk, where we showcase opportunities for actuaries in banking. My name is Michael Tcharewa. As most of you already know me, I do chair the IAA Banking Forum. Today, it's a part 2 of the market risk webinar. And our speakers here is Lawrence Habebe. He's a very experienced banking practitioner and actuarial professional, and very knowledgeable in market risk. And we also have Ian Allen, also a very experienced banking practitioner, probably 40 years or more in banking practice. And I also would like to introduce Nancy Kelly, who has helped us a lot in arranging these webinars this year from the IAA. So thank you very much. I hope you enjoy this webinar, the first webinar on market risk. If you did not attend the first one, the recordings are there. They are on the website as well as the presentation. So you can always go back. So this one is the more advanced version. This part is the more advanced version. Now, we want to go straight into it. And before we do that, I'm going to request Nancy just to go through some housekeeping rules. And then from there, we hand over straight to Ian and Lawrence. Thank you very much.
Hi there. The verbal capabilities have been turned off, and this is a lengthy discussion. So as you think of questions, please click on the Q&A button at the bottom of your screen and write your questions in there where they'll be answered at the end. Also, a copy of the recording and the presentation will be made available to everyone within the next day or so.
All right, thank you very much, Nancy. So Ian and Lawrence, over to you. Thank you very much for being with us.
So previous slide, thanks, Lawrence. Good morning, afternoon, everyone. Just a couple of slides from me to get back in context before Lawrence does part 2 of market risk. The Basel regulations were introduced in 1988, before this slide starts. At that stage, they applied only to credit risk. At that stage, as it happens, I was working in investment banking for UBS. So they passed me by because it was only credit risk. They used a standardized approach. They applied risk weights to 5 categories of lending, very simple model. It led to the concept of risk-weighted assets, the risk weight times the loan exposures. And that's become a fundamental term used in banking, risk-weighted assets. So capital is defined as a percentage of banks' risk-weighted assets. And when the Basel regulations were extended to market risk and operational risk, you work out the capital you need, as Lawrence will be discussing, but then you convert it into risk-weighted assets and define banks' capital or capital requirements as percentages of their total risk-weighted assets. A second point here is that from the beginning of this diagram, market risk was added, and then there was a movement to allow internal models as an alternative to standardized approaches for both market risk and for credit risk. Internal models required regulatory approval, in our case now from the PRA. This is quite a big process, not a simple exercise. So a lot of time, a lot of costs in developing the models and getting them improved. It was generally felt that banks would benefit from building their own models, understanding their risks better. And so it was thought okay if in general, not as a rule, but in general, internal models lead to lower capital requirements than standardized approaches. And the third point in this slide is all these arrows that, as we know, in 2008 in the banking crisis, the market risk regulations revealed some significant shortcomings. Some changes were made pretty quickly in the years after the banking crisis in what we call Basel 2.5 to address the immediate shortcomings. And then this fundamental review of the trading book, leading to different papers, consultations, inputs, and eventually the market risk regulations were finalized and included in the final version of Basel III. So a big evolution from Basel 2.5 to Basel III. Next slide. To remind you that this is the market risk section of the Basel regulations. The Basel regulations, 2,000 pages, about 200 pages of market risk. Laurence is making it much easier for us to know what's important, and then we can read the regulations more easily. But you see that most of them are about the standardized approach or the internal models approach. Now, with things moving on and becoming better, the standardized approach is not the simple thing it was many years ago. It's much more risk sensitive. So when banks are now looking at, should they have to do the standardized approach anyway, when they're considering should they also do internal models, the cost and effort is quite substantial, and the benefits may be reduced because the standardized approach is more risk sensitive. So Laurence will comment, but I would think probably large banks would do their internal models, but for a smaller bank or a new entrant, it's unlikely to be worth the cost. They would use the current and much more risk sensitive, much better standardized approach. Fine for me to remind you of a couple of other points Laurence mentioned before, but just to bear in mind, we're looking at this stuff at a desk level, not market risk and aggregate, a desk level, different types of assets, whether to use the standardized approach or the internal models approach. And finally, to remind you, in banking, it may be a surprise to actually starting, there is a distinction between the trading book and the non-trading book, or we might call it the banking book. In the trading book, things are marked to market. In the banking book, banks expect to hold loans and advances to maturity, loans and deposits to maturity. They're not marked to market, but they are not fully matched. So if interest rates change, as they do, banks have a gain or a loss under the concept of interest rate risk in the banking book. We've done webinars on that. Another very important opportunity for actuaries, but that's not today's topic. Today we're talking about market risk. Over to you, Laurence.
Thank you for that, Ian. Okay, so today's talk is going to be, as Ian said, a continuation of the presentation we did a couple of weeks ago on the 22nd of October, where we introduced market risk management. In today's presentation and talk, we will focus on the FRTB regulation, which is the Basel III component to compute the market risk capital charge for all trading book positions and FX, foreign exchange and commodity positions in the banking book. The outline of today's presentations, first, we'll start with the motivation and the issues with the current regulatory regime, meaning we'll talk about what were the issues with the Basel 2.5 that was introduced in 2011 and what changed in that particular regulation and led to the latest publication of the Fundamental Review of the Trading Book, which was published in January 2019. Then we'll talk about the different timescales. Where do different countries or region stand in terms of the implementation of the standards? We'll look at a snapshot of what changed in computing market risk capital between Basel III FRTB and Basel 2.5, what changed in terms of risk metrics, and the standardized and internal model capital formulas. And then we'll introduce the highlights of Basel III FRTB, looking at the trading book, banking book boundary, the different ways to measure market risk activities based on the standardized approach and the capital formula associated with the standardized approach. We'll look at the measurement of market risk based on the internal models approach, the process that a financial institution needs to go through in order to nominate desks that will be capitalized and approved by the regulator to be capitalized under the internal models approach. And lastly, we'll give a case study that looks at the regulatory steps in computing the general interest rate risk capital charge. And in this particular example, we chose the euro currency, and we chose about 7 curves ranging in tenors from 1 month to 12 months, in addition to a couple of FX curves and discounting curves, in order to show you the steps to arrive at the capital charge. I will allocate the last 5 to 10 minutes for any questions. If you have any questions, you can leave them until the end, or you can ask them in the box below. So what are the motivations? What changed between the Basel 2.5 and Basel 3 FRTB? And why did the regulators amend the market risk regulation 3 times? So that was the Basel 2.5 in 2011, there was the Basel 3 in 2013, and then there was the FRTB in January 2019. Well, the basic reason here is that you want more capital, and that means that more market risk capital to cover not only the expected losses that bank can sustain on their sort of trading operations, but also unexpected losses. And therefore there was the regulatory response, and that is a comprehensive revamp of the way that market risk capital is computed at the desk level and at the trading book level, and the introduction of a leverage ratio. The change also led to using different types of models and assumptions on the way that the internal models would capitalize the market risk capital. In the Basel 2.5, we were using the value at risk metric at the 99% confidence interval, using one-day perturbations of the underlying risk factors. In the FRTB regulation, we introduced a tail measure called the expected shortfall, and the banks are asked to compute it at the 97.5 confidence level. In Basel 2.5, there was the use of single-day perturbations, and using the assumptions that the distribution of daily returns of different risk factors, whether it's the FX, equity, interest rates, are independent and identically distributed random variables, and that's a strong actuarial assumption we use. And then we can use the scale of time ruling to scale the risk metric from 1 day to 10 day. The new FRTB regulation introduces the concept of liquidity horizons, and the liquidity horizons to compute the market risk capital using the expected shortfall and stress expected shortfall based on 5. So you have the 10-day, the 20-day, up to 250 days. And the concept of a liquidity horizon here is very important, because the regulatory definition for that is that this is the amount of time it will take basically a financial institution to exit an exposure to a risk factor in stress market conditions without changing the price of the hedging instruments. So, for example, if you have a highly liquid bond, let's say, for example, that is highly rated, let's say, for example, a US Treasury note, and you want to liquidate that, the US Treasury market is liquid. So you probably can sell it in 1 or 2 days. But if you have, let's say, a Jordanian bond, which has about, the lowest of the investment grade rating, which is BBB, and you want to sell this position, it'll probably take you more than 1 day or even 10 days to sell it. And that's the reason they introduced these liquidity horizons, to reflect the liquidity of underlying different risk factors. The concept of stressed value at risk and stressed expected shortfall were introduced. And the reason for that is the market observation that in periods of excessive market stress, asset prices tend to correlate together. So if we have a war, for example, the announcement of a war, you can see major financial institutions, whether it's the equity market, whether it's the bond market, whether it's the CDS market, you can see that they all move in tandem. So in times of excessive market stress, correlations break down, and assets, they tend to move in tandem, because investors' perception of the risk increases, they become risk avert, and they start selling assets across the board. So in the introduction of a stressed expected shortfall that is calibrated to a period of stress that reflects the underlying market risk structure of the trading book is important, with limited also recognition of diversification across risk factors. So, for example, you can diversify within a risk class, but it's very limited to diversify your mark-to-market and exposures across risk classes. We'll come to this point later. The 2007-2008, one observation that was stated by the Basel Committee on Banking Supervision is that during the 2007-2008 global financial crisis, the majority of large losses sustained on a financial institution's balance sheet did not come from the outright default of the underlying obligors. So, for example, the issuers of, let's say, corporate and sovereign bonds, or the issuers of CDSs to hedge, or CDSs to insure against the default of underlying issuers. The losses were sustained because of changes in the credit rating of the underlying obligors and issuers. In addition to that, the widening of credit spreads and the lack of liquidity. So these three major contributors to the global financial crisis basically led to these extreme losses. And mainly we see those in what we call complex credit derivative products, or what we call credit products that were packaged together based on a particular risk return profile and put in a particular structure and sold to investor as a bond, where the investors would collect premiums, and make some assumptions about the underlying credits, the number of defaults in a particular tranche, or all across the whole structure over a particular period of time. So for these particular complex products that were highly complex and illiquid, the FRTB regulation introduces a new framework to capitalize these products called the securitization framework, and this applies to securitization products and end-to-default instruments. The regulatory arbitrage between the banking book and the trading book, and that's quite an important point here. So the regulatory arbitrage, what that really means is that you have the concept of a banking book and a trading book. Okay, so let's say you have a bond, and this bond is issued by a AAA sovereign. It's highly rated. It pays a coupon every 6 months, basically, and you want to allocate it to the banking book or trading book. If you want to allocate this bond to the banking book, that means that you are holding this bond until maturity. So you're only interested in collecting the coupons and the final principal and the coupon at maturity. So any movement in the underlying price of the bond or the credit spread, it doesn't interest you. The only risk that arises from holding this asset in the banking book is if the underlying issuer defaults. Vis-a-vis, if you hold this particular bond in the trading book, okay, then there are more risks that you are facing. Not only the default of the underlying issuer, but there is also the general interest rate risk. And then there is the specific interest rate risk, which is the movement in the credit spread. So the capital charge holding it under the banking book, under the old regime, the 2011 and before, vis-a-vis the capital charge holding it under the market risk regime is different. And therefore, what banks were doing, not all of them, some of them, is they were engaging in something called risk-weighted asset optimization. So they allocate the assets and their hedges to the books where they lower their capital. And when they lower their capital, it underestimates the real risk. And when losses happen, there is no capital. And that's what happened in the global financial crisis. And that's the reason that this regulatory arbitrage between the banking book and trading book is explicitly treated under the FRTB regulation with prescriptive definitions of what constitutes a banking book asset or a trading book asset. In terms of the understanding FRTB timescale, so the latest FRTB Basel III regulatory text was published in January 2019. And since then, there's different jurisdictions that basically were in the process of implementing the standard. So we can see that the only three regions, so the UK, the United States of America, and the Eurozone, they have still until 25 and 26 to implement those particular standards. The Eurozone, for example, they have up to January 2026, and the UK, it's going to be fully implemented by January 2025, and in the US in July 2025. So what has really changed in terms of the components of computing the market risk capital charge under the standardized approach and under the internal models approach between the two regulatory regimes? Well, first of all, let's talk about the standardized approach and the internal models approach. Why there are two particular approaches? Well, the standardized approach is much more conservative, and this would apply to banks that are not really considered very large. And they will consider the implementation of the internal models to get all the approvals are costly. So the standardized approach is a much more conservative approach to calculating market risk capital. But under the Basel III fundamental review of the trading book regulation, the standardized approach will be computed by all banks, irrespective of their size, as one, a fallback measure, and second, as a floor. And what it means as a fallback measure, we'll come to this particular point later, is that if you have approval to compute your market risk capital for a particular trading desk using the internal models approach that takes into account the expected shortfall, the stress expected shortfall, the cascading liquidity horizons, the default risk charge, and the non-modelable risk factor charge, and basically the capital is not sufficient based on some particular metric, then you will revert back to the standardized approach. So if you fail the model independent test, which is one of the models that are used to basically conduct an assessment whether you include a desk to compute the capital charge on a desk under the internal models approach or not. So the standardized approach, it's much more conservative, and it is basically would be treated as a floor, has to be computed by all banks, and it is a fallback option. The internal models approach will generate potentially less capital requirement or market risk capital requirement, covering the market risk capital charge, but the approval to use the internal models is very stringent, and you have to go through different steps that we will mention later in one of those slides, how to get an approval, how a financial institution would, what they have to do in order to get an approval to use the internal models approach at the desk level. And let me explain to you here the difference between the desk level and the trading book level. In previous regulatory regimes, the market risk capital charge were computed for the whole trading book. So you have a front office in the bank. The front office have different trading desks, and these desks trade in different markets, and each desk will have thousands of portfolios, and each portfolio will have thousands of trades, even 10,000s, and sometimes even millions. Therefore, when you computed your market risk metric, you only have to do it once. But under the FRTB regulation, you have to do it for each single desk. So if you have 100 desks, and you nominate 100 desks in your internal models approach, you need to compute the standardized market risk capital charge for each desk as a floor, in addition to compute the charge using your internal model. So basically, it's much more computationally intensive, and it requires a lot of work and particular steps that the bank needs to pass in order for the regulator to approve the use of the internal models. So in terms of the capital formula, for the standardized approach, you compute the capital formula based on three components. The first one is the sensitivity-based risk charge. The second component is the default risk charge. And the third component is the residual risk add-on. We'll come to explain each and every one in later slides. Under the internal models approach, we compute based on the expected shortfall and the stressed expected shortfall, the different configurations, plus the default risk charge based on an internal model that is approved by the regulator, plus a non-modelable risk charge for any risk factor that does not meet the modelability criteria as set out by the regulatory text. And these two capital formulas is basically how market risk capital is computed, and how the computation of the market risk capital, in addition to the computation of the credit risk capital, the counterparty credit risk capital, and the operational risk capital, are joined together. And then, knowing the bank's tier 1 and tier 2 capital, we arrive at the capital adequacy ratio by taking the bank's capital divided by the risk-weighted assets to arrive at the capital adequacy ratio, which should be at least 10.5% under FRTB. So let's start talking about the key highlights of the Basel III FRTB regulation, starting with the meaning of a trading book and a non-trading book. If you remember if you attended the previous talk, we talked about the difference between a banking book asset and a trading book asset. A banking book asset is simply an asset that you hold to maturity. A trading book asset is an asset that you hold with the intention of trading. Okay, now what does it mean with the intention of trading? Well, there are two criteria to define the intent to trade an asset. The first one, and based on the regulatory text, is that any asset that is a result of proprietary trading, or it is as a result of a client servicing or market making, is considered a trading book asset. So for example, let's say you have a pension fund, and this is purely a hypothetical example, yeah? Let's say you have a pension fund, and this pension fund has a portfolio of cryptocurrencies. And these cryptocurrencies are based on, let's say, the two most liquidly traded cryptocurrencies. And the portfolio generates a performance on a daily basis. So the pension fund can get into a total return swap with a financial institution to exchange the performance on the portfolio of cryptocurrencies, and the bank will pay them a fixed rate or a floating rate. This total return swap, for example, has to be treated as a trading book asset, and it has to be capitalized under the market risk FRTB regulation. For example, let's say you are a financial institution and you buy and sell assets, whether they are securities, whether they are cryptocurrencies, whether they are bonds, whether they are forex or commodities on behalf of clients. These type of assets and this type of activity has to be booked under the trading book and be treated under the FRTB market risk framework. Let's say, for example, you are a financial institution and you basically make a market. Sorry, you're a market maker. You offer bid and ask prices for a range of assets. Then any asset will be treated, if any asset is based on market making, will be treated as a trading book asset. In addition to that, so we said proprietary market making and client servicing. The intent to trade also defines the intention to trade in any particular asset where the bank takes a directional bet on the market. And what we mean by that is that if the bank, the traders, have a view, let's say, on a particular yield curve, let's take a simple interest rate swap. And this simple interest rate swap, it's basically with a counterparty. You, as the bank, you pay fixed rate on a notional annually, and you receive a floating rate, let's say the Euribor 3-month LIBOR every quarter. Now, if the intention and the perception of the trader is that the yield curve is going to steepen, then we consider this a trading book asset. Why? Because the intent is to trade and to benefit from short-term fluctuations in the yield curve. And in this particular case, as the yield curve and the yields go up, you pay the fixed rate, the floating rate that the bank receives higher as the rates go up. So it generates a positive P&L. And that kind of sort of mechanism and asset is treated as a trading book asset. If the bank, for example, want to take any position on the shape of the at the money implied volatility surface for any particular interest rate options, that would be also considered a trading book asset. Now, what are the criteria to consider banking book assets? Well, anything that doesn't fall below what we just described earlier is considered a banking book asset. So examples of banking book assets would be securities financing. So let's say, for example, you have a portfolio of cryptocurrencies and you want to basically generate some funding, short-term liquidity using the portfolio of cryptocurrencies. I don't want to get into the type of cryptocurrency, but we're talking about here category 1 cryptocurrencies, which are basically tokenized based on traditional assets, or they have some sort of stabilization mechanism backing their structure, a portfolio of highly liquid bonds, for example. So you have a portfolio of cryptocurrencies and you want to generate short-term liquidity. So you ask the bank to provide that liquidity and using this portfolio as collateral. And you can basically ask for this liquidity over a week or a day or a 2-day, whatever. That kind of transaction where the economic ownership of the underlying assets remains with the client. It doesn't change to the bank. In addition, the bank is only engaging in payable and receivable, and there is no intention of basically trading the amount of money that the bank lends the owner of the cryptocurrency, for example, or the amount of interest paid back to the bank. That kind of transaction without any trading intent can be booked in the banking book and can be treated as a banking book asset. Another sort of examples of a banking book asset would be any interest rate options that are used to hedge the duration and volatility risk of interest income, the interest income generated from different loans in the banking book. For example, another example of a banking book asset would be your liquidity portfolio. So banks hold a liquidity buffer. It's made from highly rated bonds. They are as good as cash, meaning those bonds have low credit risk, low duration risk, and low liquidity risk. Holding these assets is as good as holding a quasi-US Treasury bill. So it is very easily converted to cash. That kind of portfolio does, sometimes you do basically update the positions, but infrequently. But that kind of assets can be booked in the banking book and has a credit risk treatment instead of having it in the trading book and having a market risk capital treatment. The concept of a desk is very important because, as we said, in previous regulatory regimes, the total market risk capital charge was computed for the whole trading book, and the trading book has different portfolios. I didn't take into account the trading desk. And what we mean by a trading desk is a group of traders who trade in different markets. Some traders will be trading in interest rate derivatives, for example, linear and nonlinear. Some traders would be trading in government bonds. Some would be trading in corporate bonds. Some would be trading in municipalities. Some would be trading in foreign exchange spot. Some of them would be trading in FX derivatives. Some of them would be trading in the commodities market. Others would be trading in the equity. So you have different desks, and these desks trade different markets across different geographies. And under the FRTB regulation, all the approvals to use the standardized approach for computing market risk capital or using the internal models approach will have to be done at the trading desk level. And in order to qualify assets as trading book and banking book, to classify books as trading books, they have to meet certain criteria. So they have to basically have a well-defined risk management framework that takes into account the risk appetite, the trading strategy, the generators of the revenue, the drivers of the revenue, what type of products the desk is going to trade, the limits that were agreed by with market risk management, the expected holding period, because a trading book asset should not be kept for a long period of time. It should be held for no more than 3 months for it to qualify as a trading book asset. How are you going to book the asset and you aggregate the P&L? So it has to meet all these criteria to classify these sort of books as trading books under a particular trading desk. So now we talk about the way we measure market risk for trading activities using the standardized approach. So the capital formula for the standardized approach breaks down the capital into 3 components. The first component is called the enhanced delta plus method, plus the default risk charge, plus the residual risk add-on. The enhanced delta plus method, it computes the charge based on 5 broad regulatory defined risk classes. The first one is general interest rate risk. The second one is foreign exchange risk, commodity risk, credit spread risk, and equity risk. So for each risk class, we have different risk factor, and we get the sensitivities for these risk factors. We'll come later to show you an example, exactly what we mean by that. But the sensitivities, the delta, for example, if you have a particular curve that you use to project forward or discount your cash flows that are generated from different trades, you shift this curve up in parallel by 1 basis point. You do a full evaluations for all these portfolios. You compare the mark-to-market to today's mark-to-market, and the difference would be the change in the mark-to-market and hence the P&L for a 1 basis point shift in a particular, in parallel in a particular yield curve. So for the enhanced delta plus risk charge, we use the sensitivities, which is the DV01, that's the for the yield curve, interest rate yield curve. The credit spread 01, that's for a 1 basis point shift in the credit spread of an underlying obligo. It could be a corporate bond or it could be a sovereign bond. The vega and the gamma. The vega is the change in the implied volatility or a region in the implied volatility surface when you price options on interest rates, caps, floors and swaptions, or options on FX or equity derivatives. The gamma, which is similar to the delta, but you shift the underlying yield curve in parallel by a bigger shift than 1 basis point. Regulatory text requires a shift of 160 basis points, and for FX by spot by 15%, and the curvature. And the curvature basically is the difference between the delta and the gamma, and that gives you the nonlinear component, which is the pure curvature. So basically, the way that this is computed is that the bank will have different systems for booking the trades, and the system themselves will do full revaluation. They will shift the underlying risk factors, and basically they do a full revaluation, and they compare the two mark-to-markets and give you the bucketed change in the mark-to-market for different shifts of the underlying risk factors. The second component is what we call the default risk charge. And this default risk charge, basically, it captures the jump to default of all trading book positions that are subject for specific interest rate risk. Specific interest rate risk meaning the movement in the credit spread of the underlying issuer. And that excludes securitization and correlation trading portfolios and end to default products. So basically, we're talking about corporate, sovereign, and municipal bonds in addition to equity positions. In order to compute this, we need three components. We need to look at the notional of the trade, the cumulative P&L through the mark-to-market, and basically some assumptions on the loss given default. And the loss given default assumption, basically, this is from credit risk, says that if an issuer defaults, how much are you expected to get back from the notional amount? So you're talking about an LGD assumption of 40% or 70%. That means you're about to get 60% or 6 cents on the dollar, or 70 or a 30% LGD assumption where you get back 70% if the underlying issuer defaults. The idea behind it, as you can see here, so this is a particular snapshot from a particular system that generates the static data of the underlying bond portfolio. So in the first column P, you can see the issuer category. In the second column, the seniority, is it covered, secured, senior, non-secured, subordinated debt? Then it tells you the current mark-to-market price that is observed in the market. It gives you the notional, whether it's positive or negative, depending on if you are long or short the position. It gives you the cumulative mark-to-market loss since inception, and it gives you basically if it's senior or non-senior, and it computes the jump to default risk charge. This is basically the gross jump to default risk charge based on this particular formula here for all long and short positions. Once you get the gross jump to default risk charge, you multiply it by a regulatory risk weight. And as you see, the regulatory risk weight here, depending on the rating, ranges from 0.5% up to 100%. Once you multiply the jump to default risk charge for long and short positions, you do netting. Meaning if you have a long position in a bond and a short position in equity for the underlying, depending on the seniority, you can net the position and come out with a net jump to default charge. You can then allocate these net jump to default charges per credit rating into 3 buckets. And the regulator defines the corporate bucket, the sovereign bucket, and then municipal and local authority bucket. And each one will basically contain the seniority of the debt. So what you see now is basically what you send the regulator. You do the computation. You do the computations, and you send them basically this screenshot that shows you exactly the jump to default risk charge per bucket and rating and seniority of the debt. And then basically you come at the total default risk charge, which is the sum of these three. So this is basically an example of how to compute the default risk charge under the standardized-based approach for a portfolio of corporate, sovereign, municipal bonds and equity positions. The third component of the standardized approach for computing market risk capital is the residual risk add-on. And what this says is that if you have any complex products, okay, that have a nonlinear payoff, you take the notional of that product and you multiply it by 1%, you get the market risk capital charge. And what does it mean to have a nonlinear product? Well, a linear product would be a bond. So if you want to compute the value at risk of a particular bond, it is sufficient to look at the movement in the delta and a bit of gamma, because the delta, the movement, which is the credit spread, the movement of the underlying P&L, the mark to market and the P&L, for movement in general interest rate risk and specific interest rate risk can be captured by the delta and a bit of gamma. But for nonlinear product, it has to basically broken down into higher crosses, and therefore barrier options or Asian options or basket of options. Because if you take equity baskets, for example, you cannot break it down into simple chains of puts and calls, because you have to take the correlation of the underlying instrument into account, and that's a risk factor. You have to account for it, if it's modelable or non-modelable, and therefore it has to basically fall under the residual risk add-on. You take the notional of that, you multiply it by 1%, and that's your market risk capital charge. Barrier options, FX barrier options, for example, if the payoff would say something like, okay, for example, this is a hypothetical example. If the euro dollar, okay, touches a particular barrier, then the payoff function activates. Or if this rate touches the lower barrier, it gets knocked out and the trade dies. Those kind of products will be capitalized under the residual risk add-on. In addition to Asian, meaning they don't only depend on the value of the underlying or the value of the multiple underlying at maturity, but there's path dependency. They depend on the whole path because you're taking the average of that. Those kind of products would be capitalized under the residual risk add-on capital charge. So the standardized approach basically takes the sum of those three components, and that's the market risk capital charge and the risk-weighted assets under the FRTB standardized approach. What's the symmetry? What about the market risk under the internal models approach? Okay, so before we get into the different components, let's talk about the model approval process. So the most important thing here is that you have to go through all these steps, and these steps include: one, the modelability of risk factors. If you're going to use the internal models, you have to prove to the regulator that these risk factors are modelable and they meet the regulatory criteria. Plus, the desk has to pass some tests, the P&L attribution test, the back test, the model independent risk assessment tool. The P&L attribution test is simply saying the following: you have a desk and it trades interest rate derivatives, for example. The P&L generated has to be broken down into its drivers, right? So basically, you have to approximate the P&L using the delta, using the vega, using the curvature, using the gamma, using, for example, other higher order sensitivities. The back testing, basically, you need to back test your expected shortfall model based on a VAR metric using one-day shocks, and the model independent risk assessment tool. So this is basically a tool that is used it applies at the desk level, and basically it applies to desks that trade illiquid and complex products. And the idea behind it is you want to make sure that your exposure at the whole desk, okay, is always less than the amount of capital at that desk based on the IMA approach, the internal models approach. Yeah, the meaning of exposure here is a bit complex, because if you're dealing with derivatives, the exposure has to be computed based on the standardized approach for counterparty credit risk at the instrument level and at the counterparty level, taking into account netting agreements, if it's margined or non-margined. And the exposure would be at the instrument level, aggregated across all instrument, is a function of the replacement cost and the PFE add-on. And the PFE add-on would be a function of the underlying risk factor driving the value of the transaction, or the underlying risk factors driving the value of the transaction. if there's more than one risk factor driving the value of the transaction. So it gets complicated, and that's basically, it's a tool they use to assess whether you have enough capital on the desk. So these are the steps that basically any bank needs to basically go through in order to get regulatory approval to use the internal models approach to compute the market risk capital based on the internal models approach. So, I mean, what are the components of the internal models approach? Well, the first component is a shift from using the value at risk metric to the expected shortfall. And what we mean by that is we know that the value at risk under Basel 2.5 is a frequency measure. It tells you how much you're expected to lose over a given, over a particular horizon at a particular confidence level. But if your losses exceed that confidence level, it tells you nothing about it. That's why they introduced the concept of the expected shortfall, which is the average of the losses in the tail, which is a frequency and severity measure. The horizon. In the old regulatory regime, we could use one-day perturbations for the risk factors, apply a square root of time rule, and then basically get the 10-day VAR. In the new regulation, we have to use 10-day perturbations. So let me tell you exactly here what we mean. The way we compute VAR is, let's say we need to generate P&L vectors, right? So let's say we have a trading book and we have basically a snapshot of all market codes across all risk factors today. So for each risk factor, we use a history that goes back 301 days. And for each risk factor, we compute the distribution of the return, whether it's additive or multiplicative, which is the difference in the value of this risk factor over one-day shocks. We use those shocks, or what we call perturbations, and we apply them to today's codes, and we generate 300 future scenarios. We do a full revaluations of the portfolio for each scenario, and we take the difference between the value in particular scenario and today's mark-to-market, and that would be my P&L. I will order the P&L, put it in a distribution, I'll slice it and dice it, get the VAR, and get the expected shortfall. That's the old regime. In the new regime, the perturbation has to be based on 10-day shocks. So instead of looking at the difference between the value of a particular risk factor over 2 consecutive days, I have to look at over 10 days, taking overlapping time periods. Yeah? Taking overlapping time periods. And then I can scale the 10-day into 250, into 60, into 120. The confidence level for the value at risk was at 99%. The expected shortfall is at 97%. The calibration and the diversification. Now, the configuration of using the internal models, the expected shortfall and the stress expected shortfall under the IMA approach has different levels. It has to be computed for 5 risk classes: the general interest rate risk, the FX, equity, credit spread, and commodity. There are 6 levels of aggregation, right? So you have the risk factors, and then you have for the whole trading book. In terms of P&L vectors, you generate a P&L vector for each risk factor, and then you need to generate a single P&L vector for all trades under all desks, under all portfolios for the whole trading book. That would be the diversified one, yeah? Then you need to take into account the liquidity horizons per risk factor. And there are 3 configurations. So you have the reduced set of risk factors and the full set of risk factors. And the reduced set of risk factors need to explain at least 70% of the changes in the P&L. So you say the change in the P&L at desk A, for example, is X amount, and that X amount is driven by changes in this particular risk factor and this particular bucket, which is the delta, the vega, and the gamma, and basically other sort of sensitivities. In addition to the expected shortfall metric, we have 12 minutes left. In addition to that, we have the default risk charge, and this is computed for all trading book positions that are subject to own funds requirement for one type of risk factor driving losses, and that is the outright default of the underlying obligors in the portfolio that contains, let's say, corporate and government bonds, floating rate notes, total return swaps, single name, and index credit default swaps. The difference between the latest Basel III default risk charge and the Basel 2.5 incremental risk charge is that the IRC was more qualitative, and the regulator left a lot of space to basically develop the quantitative aspects of the model. But under the FRTB, the DRC is much more prescriptive in terms of the quantitative aspect of the model. So, for example, it has to use a 2-factor model, meaning that the defaults in the portfolio, okay, are generated using two systemic risk factors. One of them could be geopolitical risk if you have some certain data to reflect that geopolitical risk and its impact on different risk factors in the market. It could be a macroeconomic variable, but the defaults in the portfolio has to be driven by two systemic shocks over a 1-year horizon, and the sovereign defaults, basically sovereigns who are highly rated, let's say AAA, the probability of default has to be floored at 0.3%. So we see that the regulatory requirement to compute the default risk charge under the internal models approach, it's much more quantitative and prescriptive. And a model like this would take at least 2 years to develop. So first of all, market risk methodology will develop the methodology. They will develop what's the input to the model, how the calculations are done, what are the assumptions, what are the output. They do the calibration, they do the model prototyping. Then it goes to an internal committee at the bank called the Model Validation Committee. It goes through all the checks there, and that would take at least a year. After that, it has to go to the regulator. That could take another a year minimum. And then when you get the approval from the regulator to use your DRC internal model, it has to go back to your risk IT, your guys, the developers who are going to develop the system in, I don't know, MATLAB, Python, or C++. Then it has to go through review. So a process to develop a model for FRTB could take at least 2 years to get the approvals from the regulator. And the third component, which is quite important, of the computing the market risk capital charge, we have 10 minutes left. The market risk capital charge under FRTB is the definition of a modelable risk factor. So the regulator has a strict definition of what constitutes a modelable risk factor to include in your expected shortfall model. So for example, it has to have 24 observations in a period of 1 year, and the distance between two observations should not be more than 1 month. It should be based on available price, and that means the real quote meaning is that it has to be an actual transaction. It has to be a verifiable transaction. So what the regulators is trying to achieve here is that he wants to make sure that all the risk factors, these are the risk factors that are used in the valuation of different products and to compute the risk and regulatory reporting, they have to be liquid. Now, market liquidity has different dimensions. So in order to assess the liquidity and the modelability of risk factors, you need to have a policy. So call it, for example, a policy to assess the liquidity of risk factors that go into risk and P&L reporting and valuation. And that means you need to understand the dimensions of liquidity. And these dimensions of liquidity based on the regulatory based on regulation and the literature, you need to look at the depth of the market, the breadth of the market, the tightness, the resiliency, and the immediacy. And in order to measure all those, you need some metrics. For example, you look at the bid-offer spread, you look at the trade volume, you look at the some illiquidity ratios, the market efficiency coefficient. So you need to assess whether these risk factors are liquid enough, they satisfy the regulatory requirement, and based on that, they can be included in the expected shortfall and stress expected shortfall model. If a risk factor is not modelable, then the bank needs to come up with a way to capitalize it. And that would be based on assessing the materiality of this particular risk factor. So let's take a cryptocurrency, for example, and this cryptocurrency is tied to a particular currency. First of all, the bank needs to assess the materiality of this particular exposure, meaning that they need to assess whether the market risk capital increases by at least 5% if we add this particular risk factor to the total market risk capital, or if this risk factor consumes at least 5% of the market risk capital allocated to the whole trading book. After you assess the materiality, you have different ways to assess that. Basically, you can use sensitivity analysis by shocking the underlying risk factor, keeping all the other risk factors constant, and doing a full revaluation and seeing how shifting the risk, this particular risk factor up, let's say by 1 basis point or by 160 basis points or by any value that you want to see the impact on the P&L. You can use scenario analysis, use the rates from a particular history, and basically do a full revaluation and basically do the assessment through that. And then you need to come up with a particular model. And that model could be a VAR model. It could be a capital add-on. Either you add it to the existing expected shortfall capital charge, or basically you can included as an independent risk charge in addition to the market risk capital formula under the internal models approach. Some examples of the non-modelability of risk factors, for example, dividend yields that are non-modelable for many reasons. One of them is that liquidity, dividend yields, for example, implied correlations between different markets, FX and equities, FX and interest rates, implied correlations between, let's say, FX trades, model parameters that are used to generate economic scenarios. So if you want to generate an interest rate scenario, let's say you want to simulate 3-month LIBOR over a period of 10 years, you need a particular model that has parameters. You calibrate those parameters to the market, and then you make some assumptions to generate forward these scenarios. Those model parameters are not observable, but they are risk factors. How are you going to account for them? So you need a capital charge that reflects the materiality of those risk factors. For example, category two cryptocurrencies, okay? They are basically capitalized under the standardized approach, and they're not capitalized under the internal models approach because of the non-modelability of risk factors. Finally, let's see this particular example. This particular example is about how to compute the market risk capital charge for a hypothetical portfolio that contains exposures to different interest rate curves in euro. So as you see here, the curve name, we have different curves. We have 1, 2, 3, 4, 5, 6 curves. And we have the tenors. These are the native tenors. And what you see here in red and black, these are the deltas. So basically, we shifted each one of these curves up by 1 basis point. We did a full revaluation of all trades, and that is the interest rate sensitivity per bucket. The bucket is the risk maturity, right? So basically, the first step to compute this is we need to do a mapping between the tenors in the system and the regulatory tenors. The regulatory tenors, you can see them here, called the FRTB tenors, 3-month, 6-month, 1 year. What this is saying is that for this particular curve, what is the interest rate earned over a 2-week period, or what is the euro discount value for an 18-month cash flow. So basically, we do a mapping between the system tenors and the regulatory tenors, and we aggregate those deltas per risk factor. So we said the risk class is general interest rate risk, and the risk factor
Lauren, sorry, you've cut out.
Sorry. Can you hear me now?
Yes.
Yes. So basically here, this is the tenor, and these are the different risk factors. So what we do is after we aggregate the deltas per risk factor, we multiply it by a regulatory weight. We arrive at the weighted sensitivities, and then we do a summation of these weighted sensitivities across all buckets. So for example, we take the 6-month, the 3-month, we sum the basically weighted sensitivities under each curve using regulatory prescribed correlations. We do this for all buckets, and then we sum everything under the same risk class, and we arrive at the capital charge, which is the KB figure here. That's 190 million euros for basically all exposures, and that's only the delta risk. So we haven't even computed the vega for options or the curvature risk charge. So I think that will give us 2-3 minutes for questions, and thank you very much.
All right. Thank you very much, Lawrence. I think another great presentation from the last one. We only have got one question, so that's great. I think that leaves enough time for that one question. Lawrence and Ian, thank you very much for the great presentation. The only question that we have got is from Nikki. She says, I'm assuming it's a she, what is the central bank's role regarding the trading book? So that's the question.
Well, the central bank is the regulatory authority that will approve the use of the internal models. So the Bank of England will approve the use of the internal model by a financial institution. The Bank of Jordan, the central bank, will approve these particular models. So the regulator, this is the regulatory body that the bank will engage in to get all the approvals, basically in order to to calculate your capital charge, the amount of capital you should hold in order to calculate your capital adequacy ratio. So that's the authority that will engage with all financial institutions to get all the approvals to report your capital charges as a bank.
All right. Thank you very much, Lawrence. There is no other question. So thank you very much. Just in closing, Ian, I don't know if you have got any one last word you want to say before we close. We are just 1 minute to the time to finish.
No, I would just like, on behalf of the people who attended, to thank Lawrence for this. I think for actuaries coming to market risk, there's nothing we can't understand. There's nothing academically intellectually difficult. There's a lot of information, volume and complexity. I've been involved in this from time to time in my career, but not in recent years. And I really myself appreciate being brought up to date on the current regulations. So on behalf of the people here, thank you, Lawrence, for your excellent overview. We can now read this stuff and understand it so much more easily. Thank you, Lawrence.
Thank you, Ian. And thank you, Michael. Thank you.
Excellent. So thank you very much, Lawrence. Thank you very much, Ian. And Nancy, thank you very much for all the great work putting all this together. And to all the attendees that are here, thank you very much for attending and listening. There is a recording. We know that there are a lot of people who have registered. Some struggle to then join, but there is a recording. Nancy will share the recording to everybody, everyone who registered for this. Otherwise, for 2024, the IAA Banking Virtual Forum has finished with these webinars. I think we've done very good 5 webinars in 2024. We will see you again next year in the first quarter when we continue with the webinars. We just want to showcase that as actuaries, as actuarial professionals, you have got a very big role to play. It's intuitive in the banking space, in banking risk management, and many other areas. So that's what we're trying to do. And as you can see, Lawrence, a specialist in this area, is showing you as if it's so easy and straightforward. Probably that's why it is easy and straightforward for actuarial professionals. So see you again next time. And thank you everyone for attending. Ian, Lawrence, thank you. Nancy, thank you very much.
Bye for now. And thank you all. Bye-bye.